one takeaway I would hope that you would have from the three scenarios is the current position and structure of our debt cannot be changed in any significant way without consequences. That's the one thing I would hope all of you saw in those three scenarios. If your priority is we want to shorten the debt and get closer to what Moody's says a credit, a AA credit, county in Tennessee the size of Blount County is, then to get to paying 75.9% of our debt principal off in 10 years is going to be rather painful and expensive.
65 cents plus.
If our concern and constraint is let's not lengthen our debt, then that hurts that same measurement, because Moody's would say in a typical financing you'd want to pay off principal sooner rather than later. The concept being you set a tax structure to finance, to pay for the financing that's in place, and if you're paying it off in a normal way, then you've got a tax structure 5, 10, 12 years from now. If you're adding debt at any point in time there, you've got the capacity to pay it off without having to raise taxes. That's the theory behind that. And our debt, we're probably a few years long, but our debt is for schools, and most schools have a life of greater than 20 years. So you have to keep that in mind too. We have to balance the conversation. What's the value of the asset? And schools have a longer life than most things you would finance. So that's probably a legitimate reason for doing that. I've had a number of individual conversations with you. Everybody likes to ask the same question. How did we get this way? I have no idea, folks. We had a major financial upheaval in 2008. And it just upset the financial markets. Whatever the powers that be at that time, the county commission at that time, the administration at that time, they had their reasons for recommending whatever they recommended. And I know that you had bond insurers that went out of business at that time. So, point is, it does no good to second guess. The issue is, what do we have the tolerance for? Now, the only thing we have to do is we've got to take care of that bank loan with U.S. Bank in December of 16. And if you're following the financial markets right now, interest rates are certainly moving in our favor right now. But they were moving in our favor on our last financing, and then they took a sharp turn up right at the end. So, again, no answers or decisions have to be made today. But we do have one that's going to have to be made, and we'll do a competitive process. One change that's going on in the marketplace right now that didn't exist when we got this 3-year bank loan is banks are interested in longer term loans now. I've had 2 major international banks already visit me and say, you know, we don't really look at 3-year loans anymore. We're looking more in 5, 7, and 10-year terms, not 3-year. Well, when Lauren did the RFP process in 2013, we asked for longer term. I think we got 1 7-year response, and it wasn't even worth talking about because the interest rate was too high. But right now, at least from 2 major banks, one of which holds Blount County paper, they would be interested, as of right now, in doing a longer term loan if that's the route we want to go. So circumstances have changed in 2 years' time. So
You don't know what interest rate that would be, though, do you?
No.
Longer term.
No. They're shopping right now. They're coming around to say, here's what we're thinking. We'd hope we'd have an opportunity. Well, you'll have an opportunity to sharpen your pencil.
Is there some way with these 3 different methods that we can project if we need money in the future, if we have to take out more loans because of some of the age of the schools?
Well, regardless of the need, if we as a county have a need to build something that requires this type of public financing, if your heartburn right now is you don't like back-end loaded debt, and we don't change the structure of what we have, you're gonna be doing back-end loaded debt. So there's gonna be an art to this, it's not all science.
On page 14, the summary scenarios, there's the cost of each scenario. My question is, like the last piece of debt we refinanced, there was a lot of fees to change the structure. This amount is only your interest that you're paying. It don't include fees and stuff to restructure. Is that correct?
No, we actually did account for, if any one of these scenarios included swap terminations in whole or in part, everything was factored into
Okay,
this.
great.
Yeah, no, I mean, that's, and I will say, that's one reason that there is less opportunity to kind of break even, if you will, and try to adhere to some of those objectives because of the swap components or those contracts that would be terminated.
Mm-hmm.
Go to scenario 3, I think we're paying 46, 47, 48 cents of the tax rate and the debt service. That goes to about 65 cents of the tax rate.
Thanks,
It's about the same as the insurance storage.
Right.
Question, Chairman, that's about an $8 million difference there, and 8 times 3 should be about 24 cents on the debt.
Let's see, it's gonna go to
About 320,000 per penny.
317, and paying 40, we're paying out 46.
But not the difference.
23 million a year.
The red line in the top of the level 3 is about $8 million a year.
23,800,000.
I don't see
3 million.
any appetite in this room to do this. I don't want to prejudge what any of, we might all want to, but the price tag, it's kind of like having champagne taste of beer pocket.
But we might want to do some type of high.
You might, and that's what I want to make sure. It's a very good point. You could play what if scenarios till the cows come home on this, and I think what Lauren's done is just try to get you 3 snapshots to give you a taste. And then I do think you bring up a good point, Commissioner. There may be some variation of this. It may not be out here. We may want to bump this up a little bit to trim a little off back here or something.
Randy, why would a bank in these times, the interest rate so low, do you want to go out and make us a 10-year loan? Mike, you and Mike, could y'all answer that?
My personal opinion, that we effectively have nationalized banks now. Your big banks. You may disagree.
Yeah, it's all about the spread. I mean,
Yeah.
you price it to the risk. So, I mean, it's not like you're gonna go get it.
But there's only one way for the interest rates to go. If you ain't making a 10-year loan and then the feds run the interest rate up, they're gonna be losers.
Yeah, but Japan thought rates were going up. 2 decades later, Japan's still sitting at 0.
But it's all about a buffer, and it's all about pricing according to risk and how long
We're
you
what?
term it out there.
41.5 cents over the 30-day LIBOR.
Yes, it's actually a percentage of 30-day LIBOR plus
Yeah.
41.5 basis.
So the spread Mike's talking about right now, just put it in practical terms, we're paying U.S. Bank 41.5 basis points over 69% of the 30-day LIBOR.
Yes. So 0.412 plus the spread. I mean, it's we're less than 60 basis points or 0.6%.
And the other part of that topic is, from a risk standpoint, when you're talking about loaning to a governmental entity, it's the power of taxation.
Yes.
So the risk goes way down because of that.
But for a credit facility, if we stay the other way, we would pay 68 basis points, weren't we?
No, we trimmed, I think the projected savings on this piece of the 2013 debt was 3 years, would save us roughly $1.5 million. In practical terms, what it did is we saved enough money with the float in interest rates and cutting the fees. We were using about $1.2 million worth of fund balance in our debt service fund to balance the debt service budget each year. The next year after that financing, we broke even. Or almost broke even. We had to use no debt service, no fund balance. So that was a positive move.
Okay, the chair will entertain a motion to adjourn.
So
Is there a second?
Second.
All in favor, say aye.
Aye.
Now, if Joel stay here a couple of minutes, Randy can answer some more questions, okay, with Joel, we got some press here. So, but I really want to adjourn.
That's fine. And you can ask Lonnie any questions, too.
Page 9. Can you go to page 9?
Page 9.
Sorry about that. Do you want me to do it again? I'm just kidding.
No.
No, please don't. This one?
So, if it's too hard to explain, that's fine.
No.
Thank you. The top part you mentioned, what I'm trying to understand is why we have contracts and the bottom part's typically what it should look like.
Yes, that's correct.
But if we
2031.
have the contracts, what's keeping the top from looking like the bottom?
So these contracts were entered into years and years ago. So I can't speak to why they were negotiated like that, but they were done at a level where the county entered into these contracts knowing this. I mean, like it was spelled out in a contract format that it would pay out differently than the bonds. So it was no, it didn't change over time, is what I would say, is that this has been like this since you entered into these contracts. It's just atypical for a local government, because the intent for those contracts is that it moves with your bonds, so that you have the protection of that contract. The contract is simply that. It's a contract. It's a hedge. It's to cover you when interest rates move up or down or whatever. You have, in theory, locked in a fixed rate through that contract. And the idea behind them, the whole idea is that fixed rate should be, and what would have been, I have to assume, is lower than what you could have borrowed at a traditional just fixed rate. So it made economical sense to do so. I cannot answer why it looks, in 11, 12 years I've done it, I've never seen one like this. So this is what I want you all to understand, is we felt in looking at this, is it wasn't helpful to see this until you saw the one below it. And to know the only way to get it to look like that is to really terminate the contracts and start all over, and there's no way that makes sense.
It's called tax increase. To get those blue lines, you have to have tax increase.
Well, let me tell you what, 2017 through 2023 was and before was so you didn't have a tax increase.
Right.
What's becomes obvious is that you can't, in this interest rate environment now, you'd be nuts to go from 2017 to 2023 in one of the lowest rate environments that you've had and not pay rates.
You might vote to do that, I'd never recommend it to you.
So,
But it'd be exciting in 2032, because all that's naked, all that puts the whole county at risk.
Yeah.
32 to.
Yeah, I mean, so.
That's why you need to do it now.
Yeah, you're totally right. If you do nothing and we all sit here and you never do anything, and I will say it's also unfair just to look at one piece of debt without the entire portfolio. I will be honest with you. But you cannot see it when it's buried in all these other moving parts. It's hard to really understand, what is this, what are you trying to tell me? And what I'm trying, is exactly what you just said, is if you do nothing, and you sit out there, there's $45 million right here that has no contract assigned to it. And if rates are at 40.4%, well, fantastic. If they're at 12, 18,
That's also the represents 40% of our debt, correct? So it's pretty.
so this piece of debt in general represents 40% of your debt right now.
I've got one more question.
Yes, sir.
I'll quit asking
No,
questions.
no.
Page 13, scenario 3, or the one where we, that.
This one?
Yes,
This is
so,
scenario
I'm
2.
sorry, 13.
13, okay.
Page 13.
Yes, sir.
Okay. The red line represents what we're paying right now with our current tax rate.
Yes, sir.
The difference between that 15, the red line, the top up there is seven, maybe $8 million a year.
Sounds about right. Yep.
Is that about right?
Looks like
Let's
it's,
say
it's right at 15, and I don't have the specifics for this.
Okay.
This
Let's
is
say it's-
15. That looks like it's about 22 and a half, 23.
Let's say 8 million.
Sure. Yep.
Okay, so, Commissioner Chairman, what I was trying to say there a minute ago, at 8 million and a penny's 300,000, we're talking 3 times 8, that's just about 24
About
cents.
25 cents.
About 24, 25 cents increase.
Added on to the 46 cents, gets you on up there.
The red lines, we're already paying the red line,
Yes.
so we're just adding on to the red line.
But you would add on to the red line, that's right.
Right.
Yeah,
So you take the tax rate, you take our current tax rate.
They go to about
goes
63 cents.
63 cents, be
Total.
going to that.
Oh, total.
Yeah,
I'm
but
talking
he's
about.
not talking about
I'm
what
not
we
talking about total, I'm
increased.
talking about.
He's talking about
23, 24 cents.
25
increase.
cents is would be the increase.
Commissioner
Okay, I got it.
we pulled teeth to get from 43 up where we are now.
I know, I just wanted to see, okay, I just want to make sure.
But that's right, you're right.
Okay, I thought you was telling me it was 6.
But
Okay,
just,
I'm with
just
you.
think, if you hold the tax rate where it is and allocate that money to get it up to 63, where general county, and the schools isn't an option.
I'm okay with that, I'm just making sure we're on the same page.
Now,
Didn't we have fun?
the one thing that everybody needs to be mindful of, there's a lot that goes into the discussions with comptroller's office. Lauren's earlier point was, they passed a law last year, basically no balloon debt law.
Right.
Now, the problem that they have in administering that, I think, is for governments like us that have demonstrated some responsibility to get rid of some of our swaps and lessen our reliance on variable rate debt. If we don't restructure, we don't have a choice but to have some balloon type debt. But they'll have to give us a waiver to do that. So there's gonna be some back and forth with them, and everybody needs to understand, that's not as simple as me having a phone call or Ron having one. That's probably multiple phone calls and multiple visits down there to kind of talk to them and help them. They have to understand what we're doing. They were tickled to death when we told them that the commission had voted to take that $20 million and fix it permanently and pay off that swap. And 30 minutes before you all were to vote on the resolution to approve the bond sale, we still had gotten their letter. I panicked. So they can talk a good game, but it's a little more difficult to get it out of. And it's not at our discretion. We could very easily go down there with a concept and an idea, and they just tell us to go try something else. They're not going to sign off on it. And part of that is because they do not want, and we've demonstrated a willingness to pay, raise property taxes to pay for our obligations. And there's a lot of communities that are not doing that.
And a lot of people sit on this commission, and the old commissioners don't get mad at me. Because the financial world went crazy, and you did what you had to do. A lot of people in these seats, we didn't put us in this shape. No. And the financial markets put the other commissioners in that shape.
I'd like to ask another question if I could. It's related, but I would like to know from your viewpoint, Randy or Lauren, is, I understand we have the policy to keep the 20% variable rate. Is that a smart thing to do in your opinion, or not, or?
It personally doesn't create, or professionally create a problem for me. I had a very similar policy when I was finance director in my former life. It's not it is a requirement that we have a policy, and it is a requirement that the state sign off on. And both of those have been done, and it's been relatively in recent times. I think it was 2012, right before I got here, actually, is when y'all passed it.
That's when we hired PFM.
Okay.
Right. It may not benefit us to take it to 20, right? We don't have to do that. It's just
That's
that way.
That is a legitimate discussion, and that may be a point but understand, for purposes of the analysis, we had to have somewhere to start from, and our policy is where we have to start from.
I think the only point I would make to this group is that it's a policy, right? It's a policy, it's not a law.
Is it a smart policy?
I will say, and that's a good question. I will say that with every local government that I work with, we advise them that they have some policy in place, because if not, how do you have this conversation? Where do you start? It gives you a framework to live within, to start making decisions. It gives you those guardrails. And 20% is a comfortable level. We've seen the rating agencies be pretty vocal that, that's a level that you can live within. And when you start looking past that, you're going to have to demonstrate an ability to live within the uncertainty. I will say at this point, technically you have more exposure to the variable rate markets because you're at 39%.
Lauren, if you look at our total debt picture, and how much of that is amortizing now versus and what the life of those loans are, then how do we fall in the 75.9%?
You're at 48% right now. You're paying, starting in fiscal 17, for the next 10 fiscal years, you pay 48%.
So that's all, including all debt. Okay.
We're at 60% of what we ought to be doing if we were a traditional model. And just for reference, over 92% of our debt is school debt. The only other debt we really have outstanding is the justice system. Now, and that's not all Blount County debt, because remember, we have to split pennies when it comes to school debt. So part of that debt is Blount County's debt that our system benefits from, but Maryville and Alcoa benefit from the other part of that through the taxes they pay, their county taxes that they pay. Just make sure everybody understands it.
There's a lot of this that's over my head, but what I do get is, what I want to ask that I fear that we'll get to December next year. Are we going to have more meetings like this? Are we going to be broken up in little pods and just get to meet? Where we go from here?
Can't be broken up in little pods. You can meet one-on-one.
That
We can't meet three at a time or two at a time.
But I see this as very productive, if nothing more than educating all the commissioners. But what I'm afraid is going to happen, like our last restructuring was, we get together once, then we come back to the meeting, and then we don't have time. So I'm just asking, where do we go from here?
No, I don't think we did that the last time.
I remember that Commissioner Lewis came up with a possible savings, and the clock was ticking, and we were afraid to take a chance on it because the clock was ticking.
Well, I don't want to speak for Commissioner Lewis, but I can speak for my individual conversations with different folks sitting in this room. People got cold feet on raising property taxes. That's exactly what happened.
What is our plan?
I can promise you this, if I don't get some clear direction from you, I'll have a plan in front of you for you to react to. That clock's running. Ultimately, we all know what the deadline is, and I've started this process early enough to give us time. My intent is, I do not want one of you casting a vote on debt that you didn't get your questions answered or have some semblance of understanding why we're doing what we're doing. That's the sole reason that I'm bringing it to you like this now. This is the first time I've done this in my career, frankly. Most of the councils that I've worked with had confidence. They said, you bring us the proposal, we'll vote it up or down. But because of my conversations with each of you and some of your predecessors, when I got here, it was clear to me you didn't understand as much as you wanted to understand. That's why we're having these conversations.
I'd like to say I appreciate it too. Starting early and giving us a heads up and giving me to talk about it.
I really.
Vanilla.
And to be honest with you, the state is, and I'm not dissing the state, but when you've got to go down and get permission to do anything and everything, and then all of a sudden you all may decide you want to try something different after we've already got down there, re-engaging them is not as easy as you think it is. I mean, it's just like starting all over again.
And to that point, just so you know, there are specific time frames we have to adhere to when we engage the comptroller's office. We have to give them a certain amount of time, and then if they request more information, it starts the time over. So it's not as specific, you give it to them and then 10 days later they get back to you. And I'm respectful of that because they want to understand it and they're actually there to help. So it's a little bit of an unknown time frame when we go to engage the state's office.
What is your feel, Lauren, for the fact that this 40% of our debt structure that we would go to the state and say, our intent would be to make no principal payments for the next 10 years? What are the odds that the state would look at it and go, well, okay, that's fine?
So in a scenario where you went to them and said that you were going to, and I will say that we would want to enlist bond counsel to make sure we understand what we have to go to the state for and what specifically we ask for. But if we go to them and just say we're just going to roll a note for a year or 2 years and not change anything, my understanding is they can tell you no. And let me just give you an example. The state, I also work directly with the state on their debt issuances. They issue 20-year level principal.
What? Repeat that.
The state issues 20-year level principal. So their principal payments actually stay level, but their debt looks like this. It goes down quicker because they don't make it's not mortgage style. It's not one cost. It's like this.
Right.
So you have to recognize that's their perspective and what they do for their own portfolio. Yes, sir.
Leaving the tax rate as is, which plan can we do?
Good question.
Like somebody's on here's got a crystal ball, we've never had one.
I got better to say about taxes.
Will any of those debts?
And to be honest, that wasn't a constraint that we looked to, but I can work with her.
What we pay you for?
It's a political strike, not an economic.
Yeah, I mean,
Well, the current tax rate, we couldn't pay any of it, right? Because we're not scheduled.
That's the reason we don't
We're
have
not
no blue.
scheduled to pay any of it.
That's the reason we don't have no blue lines there.
Yeah, so the answer is none.
and I guess the next question would be, in follow-up to that, even if we say, you gave me the marching orders, we're not raising taxes, period, I don't know that we could roll the 3-year note.
Yeah. With that.
Oh, because of the state.
As is.
Yeah, I don't know that we could or couldn't. I mean, that's what I'm saying. They're in the driver's seat on local government. You're the elected body, but they've got all the strings right there.
Do we have any other pieces of debt we could look at with this as far as a refinance?
Yes, sir. In fact, every scenario actually includes some combination of refinancing existing debt. So there's
To get us to
this point, because there's actually pieces, there's very small, but there's pieces that actually make economical sense to refinance.
That's why I wonder if we ought to be packaged.
That's exactly what we did. This is an entire portfolio perspective. Everything.
And if we had a capital plan right now, and we had pick a number of needs in the next year that we needed to go to the market on and finance, whether it was a school or whatever, just make it up. You ought to be financing it at this time when we're rolling this or refinancing, so that you spread your cost, all your issuance costs over a bigger bucket of projects and not just one.
Bottom line is, you better get your thinking caps on it, come up with some alternatives.
Yeah, you know, it's something to
Alternative ways to raise money.
does,
Bottom line.
well,
Better start thinking about that.
the other thing is, you know, do we have the appetite to pay just one swap off? Or you want two swaps paid off, or, you know, there's umpteen options and scenarios.
10-year road down.
I don't know where the 10-year closed today, but it's 2.06 earlier in the day. So in 2 weeks, it's gone, what, 25 basis points down.
Oh, yeah,
Well,
The other reason for getting you engaged earlier, we can deal with that 2013 B bonds before December. So that's why, that's the other benefit of starting the conversations earlier. You don't market time, but if you've got your act together and you just so happen are ready to go to market at the time the market goes down, then you've struck it lucky.
So we could submit this earlier than the
Yeah.
rates were.
Do it next month if we got.
Yes.
I mean, frankly, we're gonna go down to Nashville and start checking the temperature of the comptroller's office fairly soon. We may go next month just to see what the options are, how they're gonna look at us. Because they're not gonna give us any answers right off the bat.
They're gonna look at us first, and then give you
Yeah, I mean,
a semblance of an answer.
they don't wanna know, well, what have you been doing? How'd you end the year? Blah, 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 blah. It's like a courtship.
That could be good and bad.
Just as long as, yeah, yeah.
well, but it would be a safe bet to say anything that we did now on a fixed rate basis, in 2 years, we would look back and think we were pretty smart.
Rates are up.
Rates are going up.
Short-term
Any
rate.
lower.
Short-term rate.
Well, and I'm not talking about in 12 months, but I'm talking
Yeah.
about 24 and out. Anything we do now is a little lower rate, lower fixed rate than what's
I
gonna,
think you're right.
there's nowhere to go but up.
Mhm.
Unless Obama stays in for another 4
We
years.
did 50 million revolver, though, we thought we would have struck it rich at 39. Wait another year, maybe we could have
But the rates you're talking about that are going down, you lose me with swaps, but if we were to refinance right now, I mean, are you saying that the scenario or the market right now is very favorable to do something?
Well, it's moving in the right direction. The 10-year treasury was 2 and a nickel or 2.06%. Sometime late afternoon today, I don't know how close. But as that rate goes down, that tends to be an indicator of what you're going to be paying in interest rates somewhere in here.
And
But
to
is
Randy's
that
point,
like to the, but if it is that rate today, how is that compared to this year, last year? Is it about at the bottom?
We got down, when we were doing the last financing, the 10-year treasury got down to 1.67. And as it went down, that swap termination fee went up.
yeah, so there's a correlation between the two. Yeah, so we don't actually reap the benefit of rates on certain pieces of this debt.
It's the term swap.
Ten-year treasury closed at 2.017.
It got below 2 this morning.
I didn't even look at it till after lunch today. So, that
Okay.
gives you an indication.
Anybody else, last call? Going.
Thank you all for your time.
Good question.
Thank you.